Welcome back, everyone. Today we're going to take a closer look at Realty Income, a prominent real estate investment trust known for its consistent monthly dividend payments and long-term performance. We will delve into various aspects of Realty Income, including its recent performance, historical track record, diversified portfolio, recent activities, and how it has historically performed during different federal fund rate cycles. If that sounds interesting to you, then sit back, relax, and enjoy. Let's begin by examining Realty Income's recent performance. Over the last 5 days, the company's stock has experienced a decline of 2.14%. The situation doesn't improve when we look at the past month, with a substantial drop of 12.37% and a year-to-date decline of 23.21%. These figures naturally raise questions about the current state of the company. What exactly is happening with Realty Income? However, before we jump to conclusions, it's crucial to consider Realty Income's long-term performance. Over the years, Realty Income has demonstrated impressive results, boasting a compounded annual growth rate of 13.23% since its IPO in 1994. This remarkable performance is further supported by a consistent 4.4% compounded annual dividend growth rate. Realty Income's commitment to dividend stability is evident with an impressive track record of 638 consecutive months of dividend payments and an extraordinary 104 consecutive quarterly dividend increases. One of Realty Income's strengths lies in its diversified portfolio. With 1,303 clients representing 85 different industries and operating across 50 US states and Puerto Rico, the company enjoys a broad revenue base. Additionally, Realty Income has expanded its horizons into Europe, with strategic investments in the UK, Ireland, Italy, and Spain. Today, Realty Income is the fourth largest global REIT, with a European portfolio valued at $7.6 billion. That includes 303 assets spread across 38 industries. This growing global reach, coupled with an industry-high 99% occupancy rate that is well above the industry average, solidifies Realty Income's position as a stable and reliable income-generating investment. Furthermore, its current yield, which stands above 6%, adds to its attractiveness. To understand Realty Income's current situation better, it's essential to review its current activities. 2 years ago, they spun off their office portfolio into the newly formed Orion REIT. And unlike W.P. Carey, that just announced that it's going to be spinning off its office portfolio, Realty Income did not have to cut its dividend. This was in part due to Realty Income's scale and lower exposure to office properties. But also the spin-off was done at a more favorable time, when the cost of capital was much lower, and market sentiment for office properties was slightly better. Realty Income's main focus is and has been on recession-resistant properties, and time and again this has proven to be a winning strategy. More recently, the company successfully raised substantial capital through debt offerings, securing $400 million in unsecured notes at a 4.7% interest rate due in December of 2028, and another $600 million at 4.9% due in December of 2033. In the European market, Realty Income made strategic moves by raising €500 million at 4.875% due in July of 2030, and another €550 million at 5.125% due in July of 2034. Additionally, during the second quarter of 2023, Realty Income executed acquisitions totaling $3.1 billion, with an average cash capitalization rate of 6.9%. While the cap rate exceeds the most recent rate of borrowing, the margin is not wide. Also, their venture into Las Vegas with the Bellagio deal has garnered mixed reviews from experts and investors. Naturally, concerns arise about the impact of rising interest rates on REITs. Historically, higher interest rates have been viewed as a headwind for REITs. However, Realty Income, thanks to its size and experience, has been able to maintain healthy investment spreads in such environments. This resilience has allowed the company to navigate interest rate fluctuations with relative stability. Furthermore, historical data suggests that recessionary environments can present attractive acquisition opportunities for Realty Income. While the company may have to accept lower spreads on acquisitions financed through debt during economic downturns, these deals may prove to be more lucrative over time should interest rates fall again. Now, let's explore how Realty Income has historically performed during various federal fund rate cycles. Over the long term, specifically between November 1994 and September 2023, Realty Income boasted an average monthly return of approximately 1.22%. Breaking this down by 3 distinct rate cycles, a rising rate cycle, a flat rate cycle, and a falling rate cycle, we see that Realty Income returned 0.68% per month on average while interest rates were rising, 0.95% while interest rates were falling, and an impressive 1.68% when rates remained flat. To provide context and benchmark Realty Income's performance, let's compare it with the S&P 500 ETF, ticker symbol SPY. During the same period, SPY had an average monthly return of about 0.88%, considerably lower than Realty Income. When rates were rising, SPY returned 0.73% monthly. When rates were falling, it was just 0.01%. And in a flat rate cycle, SPY returned 1.6%. So in summary, Realty Income historically underperformed the S&P 500 when interest rates were rising, outperformed when rates were falling, and slightly outperformed when rates remained flat. Interestingly, both Realty Income and the S&P 500 performed best in a flat rate environment. Over the past 29 years, flat and falling federal rate periods, where Realty Income historically outperformed the S&P 500, made up about 75% of the time. To fully appreciate this data, we need a little bit more context, because no interest rate cycle has been the same. Additionally, there were other economic factors present during each rate cycle period that also played a role in returns. Since the late 1990s, our financial landscape has witnessed 7 significant rate cycles, each marked by distinct trends. The journey began with a period of rising rates during the late 1990s, as interest rates surged from approximately 4.7% to 6.5%. Subsequently, we experienced a swift series of rate cuts due to the dot-com bubble popping in late 2000, resulting in rates plummeting to a mere 1%. In 2004, another chapter unfolded with a rapid ascent in interest rates, ultimately reaching around 5.25%. However, the global financial crisis that struck in late 2007 led to yet another swift cycle of rate cuts, as rates plunged to nearly 0%. The following cycle emerged in the early part of 2016 and extended through late 2019, characterized by gradual rate increases, ultimately peaking at approximately 2.4%. Shortly thereafter, the onset of the pandemic triggered another abrupt downturn, ushering rates back to near 0%. Notably, our current rate hike cycle stands out as the fastest in the past 3 decades, with interest rates presently sitting at 5.5%. When we juxtapose Realty Income's monthly returns with the movements in the federal funds rate, the resulting chart appears chaotic, owing to the substantial short-term fluctuations. A more insightful approach to comparing these two datasets involves examining longer-term averages for Realty Income. Consider, for instance, the 36-month rolling average of monthly returns for Realty Income in relation to the federal funds rate. Through this lens, distinct patterns come to light. It becomes evident that the average monthly returns from Realty Income tend to improve during periods when the fund is cutting rates, or when rates remain stable and low. This trend can be observed in the intervals between the dot-com bubble and the financial crisis, between the financial crisis and the pandemic, and once again between the pandemic crash and the onset of the most recent rate hike cycle. Conversely, during periods of rising or persistently high interest rates, the average monthly returns from Realty Income typically hover below their long-term averages. Now, for a more detailed analysis, let's consider the same comparison, but with a shorter 12-month rolling average of monthly returns. From this chart, we can further deduce that the most favorable periods for Realty Income coincide with periods of stable interest rates. While falling rate cycles yield better results than rising rate cycles, they still generate returns below the long-term average when interest rates remain stable. So, what insights can be gleaned regarding Realty Income's potential trajectory in the coming months and years? The direction and quality of Realty Income's returns will be significantly influenced by future interest rates. The Federal Reserve has indicated a potential rate hike later this year, followed by a period of rate stability with the possibility of rate cuts later in the following year, although perhaps not until 2025. Looking 2 years ahead, there is a substantial likelihood of gradual rate cuts as the Fed works towards its long-term goal of 2.5%. However, recent predictions suggest that interest rates remain elevated for an extended duration, potentially taking 3 to 4 years to reach the target of 2.5%. If this scenario unfolds, it's plausible that Realty Income may continue to deliver returns below the historical average well into next year. While today's pricing may appear attractive, it could still be premature to make a substantial investment. A prudent strategy might involve gradually accumulating the stock rather than committing all at once. As interest rates eventually decline, we should anticipate an uptick in Realty Income's average monthly returns. Naturally, this assumption assumes that no other significant economic factors come into play over the next 12 to 24 months. In the event of a recession, the Fed may expedite rate cuts. Although it's important to recognize that a recession tends to drag down stock returns across the board, with Realty Income being no exception. Examining their rolling 12-month average returns, Realty Income's current position is among the lowest it has historically reached, barring recessionary periods. Should a recession materialize in the near future, Realty Income could experience a further substantial decline from its current level. Personally, I find the current price attractive and have initiated a gradual addition to my position. I acknowledge that it still might be early, and I may need to continue accumulating the stock at lower prices over the next several months before a bottom is found. Nevertheless, I maintain confidence that Realty Income will rebound in the long run, delivering market-beating returns while offering a robust and growing passive income stream to patient investors. It's worth acknowledging that Realty Income is far from a newcomer, boasting a rich history spanning several decades. Throughout this extensive tenure, the company has navigated its way through multiple challenging market cycles, consistently outperforming the broader equity market. It's only fair to commend Realty Income's management team for their unwavering trustworthiness, demonstrated consistently in both prosperous and adverse economic climates. Thank you for joining me today. If you enjoyed the video, please do me a favor and give it a like and subscribe to the channel. See you next time.